You're about to hear my conversation with Tim Brisby, Head of Tax and Estate with Mackenzie Investments. Today, we'll talk about how you can best navigate tax preparation season, why there's growing interest in philanthropic and disability planning, and why advisors play a critical role in the intergenerational wealth transfer in Canada, but not in the way you may think. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction in Mackenzie Private Wealth. Today, I'm joined by Tim Brisby, Head of Tax and Estate at Mackenzie Investments. Tim, how are you?
Doing all right, my friend. Doing all right.
Excellent. I love the good, fresh optimism in your voice, and I'm looking forward to our conversation because, Tim, most Canadians right now are in the midst, if not the throes, of tax preparation season, and every season is always a challenging time. I would say this year feels a little bit more so. I'm reading stories about people getting their slips a little bit late. There's been a couple of policy reversals, perhaps. We're in the midst of a federal election cycle, a lot going on. But why don't I turn it over to you, the expert? From your perspective, what are the top, 1 to 2 or 3 themes that you feel are going to be top of mind this tax season?
Wagner, thanks for the question. The key themes, I'll start with key dates. February 24th, we're past that. That's when we start filing tax returns. April 30th, that's the deadline for most individuals, to file tax return. June 15th would be for businesses too, And so these are key dates for folks to consider, right? But then you mentioned we're in the midst of the campaign season, shall we say. And some of the things that people have been thinking about and even hearing would be the consumer carbon tax. If you notice, I think it was this week, April 1st, I believe it was, where people went to the pumps and they're paying 17 to 20 cents less because the carbon tax has been effectively suspended, consumer carbon tax. The other one was the government led by the former prime minister. They introduced a measure with respect to the capital gains inclusion rate increase, where the first $250,000 of capital gains will be taxed at the 50% inclusion rate. And then anything in excess of 250 will be taxed at 66.67%, 2/3. Folks that planned spent serious money, paying accountants to help them plan around capital gains. And we helped clients also plan around this. But then it was deferred to January 1st, 2026. And the latest we heard from the new Prime Minister, Mark Carney, was that he will not be moving forward with this. So those are some of the things that's happening if we're thinking about the campaign season that we're on right now.
Tim, you're stressing me out. Not really, but there's clearly a lot going on. And I think in about 2 minutes, you've made the case why so many people work with a tax professional and or their advisor to take care of this, because there's a lot of complexity, and that's for the average wage earning Canadian. Now, I do want to get into your area of expertise, Tim. You actually focus your team's efforts and activities in a specific part of the space in Canada, and you're focused on high net worth, ultra high net worth Canadians. You partner with family offices, different segment. Talk to me about this segment, not so much in terms of the wealth, but why it's different and really getting to the complexity.
The high net worth space, let's say, high net worth individuals, generally speaking, the common understanding is that these are individuals that have liquid investable assets of at least $1 million. And I'll tell you this, for the first time in Canada, we have households that the average household is worth $1 million. That's something to think about. But as far as individuals, these are the high net worth individuals. And we go into very high net worth, and there are nuances there where we're talking in excess of $5 million, and then ultra high net worth 10, 15. But then family businesses and family enterprise. And these folks, very high net worth, ultra high net worth, these are not folks that are relying on T for income. And that's why business families are also core to this court. And so, in describing this, that's my description and definition of this high net worth space and the people that make up the high net worth court in Canada. What we're doing is helping advisors help high net worth clients, because the greater the wealth, exponentially the complexities would increase. And that's where we're focusing on.
Excellent, Tim. Now, Tim, we've had a number of conversations. We partner on a number of engagements. As you have said to me in the past, we can't think of high net worth as just people earning a T4. There's lots of those people, professional
Lots of them.
services
Yes.
employees. There's also in cases people are high net worth because of intergenerational wealth, but certainly not the largest cohort. Many of these people are actually entrepreneurs, business owners, and you've alluded to this, but maybe, peel back the curtain. Tell us a little bit more about how we should think about high net worth in Canada.
From the advisor's perspective, of course. Um, the way I have approached this, and that's been my perspective and mentality. And so I'm going to use a word that is technical in nature to capture the essence of the advisor's approach to their clients, but particularly to the high net worth individuals that they work with. And that word is homeostasis. Now I'm going to go someplace that people are very familiar with to capture the definition of this word, and that's the Cleveland Clinic. And so the Cleveland Clinic, they define homeostasis, how your body regulates internal systems so they function correctly. And this word, we can split this word in two halves. Homeostasis. So homeostasis, equal and holding still. Again, from the Cleveland Clinic, equal and holding still. So there's an equilibrium. And the reason I use this is that advisors occupy a privileged, I would say, place in the lives of the families that they work with. And what I mean by this is that as humans and as families and as clients, we are all seeking incremental homeostasis, harmony in everything that we do. So enter the advisor. What is the advisor's role in helping families achieve this, particularly high net worth families with the complexities that great wealth would come with? That's our approach with respect to helping advisors appreciate what these families are dealing with and how they can help in their way continue incrementally to establish homeostasis in the families, in the lives of these families.
Tim, I've seen you and members of your team engage in events across the country. And one topic that certainly has grabbed my attention has been this idea of disability planning that actually applies to so many Canadians. And I don't think is actually well understood. Did you want to spend a little bit of time on that and what you've really shared with advisors to help them have better conversations with their clients on the subject of disability planning?
Very good. And I'm going to link it back to how we started this conversation, where if you think about just the public in general, right? Um, so 1 in 8 Canadians would consider themselves to have a disability of some sort. And these days, we're talking about mental, we're talking about health, physical disabilities, and so forth. But then when you think about high net worth individuals, I don't necessarily think that with respect to planning, we think about those individuals because we suggest and we think to ourselves that they have what it takes to take care of their loved ones anyway. But then disability planning as a whole, I think, needs to come into the equation when we're working with clients. It could very simply, it could be a very simple question from advisors to their clients if they have a loved one or someone in their life that suffers from some type of disability, right? And once that question is answered, let's say in the affirmative, have you planned around this? Is it a physical disability? Do they have testamentary capacity? Do they have mental capacity? Do they have legal capacity? And if they don't, what are some of the ways? Do they need care given? Right? Should we be thinking about with vast wealth and with a child or a person with disability? Should they be thinking about a fully discretionary trust, for example, to capture some of the wealth that's being inherited by that child, right? There are all kinds of planning. It could be parents have $1 million of RIF. Their RIF is valued at $1 million, right? And they have a child with disability. They may have other children. So how do you plan around this? There could be a tax deferred transfer of a portion of that RIF into an RDSP, which the maximum is $200,000 lifetime. Planning is done that way. So you're shifting 200 of a million. And so with death, there comes the taxation, right? The RIF is considered income. And so the $1 million will be taxed. If it's in Ontario, you're talking of 53%, right? If you move $200,000 into an RDSP for a child with a disability, now the tax is on $800,000. So there is less tax liability and more that will go to the family. These are some of the conversations that we're having with clients, with advisors, and certainly with high net worth clients.
Excellent, Tim. Tim, I'm kind of struck by how many times during our conversation you've referred to families, loved ones, children, or in our conversation, we're talking about how advisors work with families, but money's very personal. Financials are everything's very personal. In our industry, we talk a lot about the intergenerational wealth transfer, but if you don't mind sharing, you have a really insightful, almost sobering story with regards to one of your children and your advisor in the intergenerational wealth transfer that I was hoping you could share with our audience.
Very good. Thanks for that question. And we see this. I see this. I'm going to give you a couple examples here. The first one is several years ago. I think it was 2018. I wrote an article that was published on Advisor at Sea. It's around intergenerational wealth transfer, and the essence of that article was how advisors ought to have a paradigm shift. Right? You're working with your client, but it doesn't end with your client. Your client has a system around them. And the system, we're talking children, we're talking families. It could be nieces, nephews, cousins. You never know. The connections of other people to your clients. So in this particular instance, I was giving a talk in BC somewhere, and the advisor that was asked to introduce me, he Googled my name. And he saw this article, and the essence of this article is reach out to the rising generation. Your client is a senior generation, reach out to the rising generation. And so what he did, he had a meeting planned for with his client, a single mom that has an adult child. And he suggested to her, would you invite your child to this meeting? And she did. So he shows up, they show up, they have a good meeting. And I kid you not, he told this story before a large audience that the very next day, this child was moving his assets from his current advisor to this advisor, his mom's advisor. And the reason the child gave was that you thought about me. That's all. You thought about me. It was just not my mom. For me personally, this is personal. My child was 17. My son was 17, and he was about to turn 18. And I thought about the TFSA, right? And I thought about beginning that process to teach him about investments. And who better than my advisor to bring into this equation to help with this process? I sent an email to my advisor. I didn't hear from him for 3 weeks. I had to follow up, and then it was delayed even getting back to me. I ultimately let that advisor go. If you know basketball, you appreciate basketball. This was a layup. I gave him a layup. He couldn't handle it. And the point of this is I want my children, and this is what advisors ought to be thinking about. I'm dealing with a client. How do I extend this to the system, to the family? That's the point.
That is quite a story, Tim. And I got to be honest with you. I love basketball. I've missed the odd layup in basketball. Your story is indicative. I don't love sports analogies, but that sounds more like a fumble at the goal line or just missing a wide open net, because the fault is entirely on the advisor. And unfortunate on the one hand. On the other hand, glad to hear your efforts to engage with your son in the rising generation and to hold your advisor accountable. Do you have a new advisor?
I have a new advisor. I have a new advisor, and this individual thinks along these lines. And that's what quite a few advisors, they get it. But what we're trying to do here is that build a bridge. Advisors are not only build bridges, advisors could themselves be the bridge. Do you see? So what I mean by that is build bridges is if you're building a bridge, you're building multiple bridges, right? The advisor occupies a very strategic place. So we're talking, how do you extend your service or extend your network or extend the connections that you have in the community? So we're talking lawyers, business valuators, we're talking appraisers, we're talking tax accountants, we're talking all of these people that your clients may have personal advisors, but the investment and financial advisor is so plugged in into the community that you can assist your clients in this way. So that's how you build bridges. And the advisor, him or herself, can also be a person that bridges this gap if we're talking generations. You've got the rising, you've got the senior. How do we bring this together? I'll give you a quick example. Talking about family businesses, right? A family enterprise that goes beyond a business. The family enterprise includes family wealth. And you can argue, but in my view, the most significant of all of this family business, family wealth, insurance, whatever it is, heirlooms, paintings, is the human non capital asset. That's what the advisors ought to focus on. And so, in this, business owners would prefer for their children to inherit the business, at least work in the business, right? But the very same business owners stats show their concerns that their children are not equipped to run the business. Obviously, there's a gap. Enter advisor, education, training. How do we ensure that the children are ready to take on the reins of the family business?
I love that, Tim. As you were telling these stories and examples, all that kept popping into my head is the best advisor is the advisor who's just helping their client, and everything from there will just come because you'll have a great relationship with your client. Not only
Yes.
will that business be strong, but you'll get referrals because you would just be a great partner to the client. One of the other topics you've talked about that I'd love to get your perspective on before our time comes to an end is this topic of strategic philanthropy. What are your thoughts on strategic philanthropy?
To give you an example, you've got a family that's worth tens of millions of dollars, and the children, they don't even realize that the parents are that wealthy. They don't. And so the parents, their plan is to give much of their wealth away. So they have two things that they're going to have to deal with. The first is, if we're going to give this wealth away, we need to tell our children that we're this wealthy, you know? So they struggled with that. How do we communicate that we're worth $100 million to our children? You know who they leaned on? They leaned on the advisor, and the advisor leaned on someone that knows how to facilitate family conversations. So we're going to sit around, we're going to have a conversation, and we're going to have this conversation around about our family, where we've come from, where we are now, what are our values. And as a result of our values, we want to give much of our wealth away. And so now you've done one thing. The advisor has helped to facilitate a crucial family meeting to talk about family values around wealth, right? Values and wealth do not necessarily equate. That's not what we're talking about. Values are much more than wealth and dollars. So they talked about that. Now, as a result of that, they can now focus on the plan of the family to give much of the wealth away. Enter someone that can help with strategic philanthropy, which connects with estate planning, connects with business succession planning, there's all of these connections. How do we do this? Do you just cut a check? Perhaps not. We need to be strategic with this, right? Because we want to leave something for our children. So you know what they leaned in? At least one of the ideas was perhaps we can purchase an insurance policy, a large one. I remember speaking with a philanthropic advisor that told me that they've got in their donor advised fund insurance policies that the premium is $1 million a year, and this is that large. So now, upon the death of the parents, that policy pays out to a charity. But then the children are also left with an inheritance. This is strategic philanthropy, and a vehicle that we obviously have here at Mackenzie is the Mackenzie Charitable Giving Fund, the Donor Advised Fund. That is a fantastic vehicle for such an endeavor.
Fabulous, Tim. Really appreciate all the details. Tim, we're pretty much at time for our conversation. I was just curious, any last parting thoughts or thought that you'd like to leave with our listeners as they go through the remainder of tax season, or tax preparation season, I should say?
Keep dates in mind, right? You know, we talked about the dates early on. The one thing, and members of my team are very good at doing this. We have a presentation, you know, that we provide to advisors and even clients that is around tax strategies, particularly, and it's called year-end tax strategies. But what I'll leave the audience with here is that tax is not necessarily what you think about in November, December, when you're thinking of donation and thinking of tax credits or tax deduction, or in February, March, and April, when we're thinking about what our RSP limits would be and time to make those contributions and to even file our taxes. It's a year-round thing. A lot of the decisions that we make should be centered around that, but we need to think about this from January through December, because there are implications as we go through the year with respect to taxes. That's what I'd leave the audience with.
That's excellent, Tim. And that is the perfect place to end our conversation. I want to thank you, Tim, for joining the podcast today, and I look forward to having you back sometime soon. Happy tax preparation.
Thanks, Ryden. Appreciate it.
The
content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.